Glad you're back. Residential mortgage-backed securities are the most common form of asset-backed securities. RMBS originating from the United States are discussed in detail in this topic. These securities represent a large sector of the investment-grade bond market and are included in the portfolios of many US as well as non-US investors. We shall learn the mechanisms of mortgage pass-through securities and how they're structured into collateralized mortgage obligations. We'll also be introduced to non-agency RMBS and learn how they're different from agency RMBS. Let's begin. In the United States, securities backed by residential mortgages are divided into three sectors. Those guaranteed by a federal agency, like the Government National Mortgage Association, commonly known as Ginnie Mae. Ginnie Mae securities are considered to be backed by the full faith and credit of the US government. Those guaranteed by government-sponsored enterprises like the Federal National Mortgage Association, or Fannie Mae, and the Federal Home Loan Mortgage Corporation, or Freddie Mac. While they're not backed by the government, these securities are considered to be of very high credit quality. Securities guaranteed by a federal agency or GSE are known as agency RMBS. The third sector, known as non-agency RMBS, are issued by private entities. Non-agency securities differ from agency RMBS issued by GSEs in two ways. Firstly, the credit risk of the agency RMBS is reduced by the guarantee of the GSE itself, which charges a fee for insuring the issue. In contrast, non-agency RMBS use credit enhancements to reduce credit risk. Secondly, for a loan to be included in the mortgage pool backed by an agency RMBS, it must meet specific underwriting standards. These standards set forth the maximum size of the loan documentation required, the maximum loan-to-value ratio, and whether or not insurance is required. If a loan satisfies all the underwriting standards, it's called a conforming mortgage and can be securitized under an agency RMBS pool. Loans that do not meet the standards are called non-conforming mortgage. Such mortgages can only be securitized by private companies for non-agency RMBS. Let's examine a hypothetical example of an agency RMBS. Tyler, Lee, and Ashok are US homeowners whose mortgages satisfy the conforming mortgage criteria. These mortgages are pooled together as collateral for a mortgage pass-through security. The mortgages are said to be securitized. The securitized mortgages in the pool can be aggregated to provide meaningful statistics for potential investors. The total principal of all the loans when added up is $10 million. The weighted average coupon of the pool is the weighted average of the interest rates of all the mortgages in the pool. The weight is each mortgage's outstanding principal balance as a proportion of the total outstanding principal of all the mortgages in the pool. If we plug in the figures, we calculate a 10% rate. Likewise, we use the same method to find the weighted average maturity of the pool, which is 15 years. Based on these figures, our mortgage pass-through security has a total principal of $10 million, the coupon rate it receives is 10%, and has a weighted average maturity of 15 years. Let's say the security is sold to two investors, Mario and Kim. Mario placed a principal of $7 million, while Kim placed the remaining $3 million. So every month, Tyler, Lee, and Ashok continue to make their regular scheduled payments for their respective mortgages. Since they're fully amortizing loans, a portion of the payment is interest payment, and the rest is principal payment. The principal goes to repay the principal owed to the investors of the agency RMBS. The principal amount of the RMBS is therefore reduced accordingly. The interest payment also gets passed through to the investors. However, not all of it is paid to the investors. A portion of it will go to pay servicing or other fees, like the insurance fee for the credit guarantee by the GSE. The actual rate that gets passed through to the investors is known as the pass-through rate. So, for example, if the fees amount to 0.5%, Mario and Kim shall get a pass-through rate of 9.5%. What we have here are payments that are scheduled. When payments simply go as scheduled every month, this RMBS behaves similarly to a fully amortizing bond with $10 million principal and 9.5% monthly coupon. However, that's not likely the case. The borrowers have the option of making prepayments at any time. This makes the future cash flows to the investors unpredictable. This is known as prepayment risk to the investors. To account for the likelihood of prepayments, issuers often estimate an expected prepayment rate from which the weighted or simple average life of the security can be calculated. Still, this is just a forecast, and actual prepayments can differ significantly from expectations, mainly due to changes in market interest rates. If market interest rates fall such that the borrowers can refinance at now available lower interest rates, actual prepayments will be higher than forecasted. Thus, the security will have a shorter maturity than was anticipated. This is known as a contraction risk. In contrast, when market interest rates rise, prepayments will be lower than forecasted because homeowners are reluctant to give up the benefits of a contractual interest rate that now looks low. As a result, the security will have a longer maturity than was anticipated. This is known as extension risk. Before we proceed further, let's study how prepayment rates are measured. In a month, the principal is reduced by two sources of payments: the scheduled principal repayments and the prepayments. The single monthly mortality rate is the prepayments for the month as a percentage of the month-end principal without prepayments. The conditional prepayment rate is the annualized SMM. A CPR of 15%, for example, means that approximately 15% of the outstanding mortgage balance at the beginning of the year is expected to be prepaid by the end of the year. In the US, CPR is measured and described against a benchmark called the Public Securities Association Prepayment Benchmark. The benchmark is expressed as a series of monthly prepayment rates. Based on historical patterns, it's assumed that prepayment rates increase by 0.2% for the first 30 months until they peak at 6%. Slower or faster prepayment rates are then referred to as some percentage of the PSA prepayment benchmark. A PSA of 100 means that the MBS is expected to have prepayment rates that match exactly that of the benchmark. Recall that the weighted average maturity of an MBS is the expected life of an MBS before it's paid off. This is assuming that there are no prepayments made at all. When the prepayment expectation is in line with the benchmark, that is a PSA of 100. The average life has to be shorter than the weighted average maturity. A PSA lower than 100 means that the MBS is expected to have slower prepayments than the benchmark, and consequently a longer average life. Conversely, a PSA higher than 100 means faster expected prepayments and a shorter average life. For example, if the underwriters estimate that this MBS has a PSA of 250, the prepayment rates are expected to start at 0.5% annualized in the first month and peak at 15% in the 30th month. So, back to our example, the underwriters have determined at issuance that the prepayment assumption of this RMBS is PSA 250. However, we know that this will likely pan out only if market interest rates remain the same throughout the term, which is unlikely. If market interest rates fall, prepayment rates increase, and the average life is shorter than expected. This is known as contraction risk. If market interest rates rise, prepayment rates decrease, and the average life is longer than expected. This is known as extension risk. One way to handle prepayment risk is to reallocate it according to investors' preference. For example, Mario is fine with contraction risk, but extension risk is an issue to him. That is, he's okay with receiving back his principal earlier than anticipated, but will have problems if the full return of principal is delayed. Conversely, Kim has the opposite preferences. She'll have problems if the principal is returned too early, but has no issues if principal is returned later than expected. To satisfy them both, the cash flow from the mortgage pass-through security can be routed into two tranches. Tranche A, which has a principal of $7 million. The cash flows into this tranche go to Mario. Tranche B has a principal of $3 million. The cash flows into this tranche go to Kim. While both tranches receive interest payments at the same coupon rate of 9.5% on their outstanding principal all the time, the treatment of the principal payments differ. In the early periods of the life of the RMBS, all principal payments, both scheduled payments and prepayments, are paid to Tranche A. This carries on until the principal for Tranche A is fully paid off and retired. Principal and payments then flow to Tranche B until its principal is paid off. Such redistribution of cash flows results in securities called collateralized mortgage obligations. Note that in contrast to a mortgage pass-through security, the collateral is not a pool of mortgages, but a mortgage pass-through security. In practice, a CMO usually collateralizes a pool of mortgage pass-through securities. Also, a CMO can have several tranches. Such a structure, where tranches are retired sequentially, is known as the sequential pay structure. This form of tranching, where the first tranche receives all principal repayments up to the principal value of the tranche, followed by the subsequent tranches sequentially, is known as time tranching. Contrast this to credit tranching in the earlier lesson on how securitization works. The credit tranching structure distributes the credit risk to different levels amongst tranches. Time tranching structure, on the other hand, distributes prepayment risk in varying fashion amongst its tranches. Let's practice with actual figures. To simplify our calculations, we shall stick with our earlier example of one mortgage pass-through security and two sequential pay tranches. In the first month, the mortgage pass-through security received $4,176 in prepayments and a scheduled principal repayment of $24,269. Interest is also passed through to the CMO. Given that the beginning principal balance in Tranche A is $7 million and $3 million in Tranche B, since this is a sequential pay CMO, all the principal payment, including prepayments, go to Tranche A first until it's fully paid up. So the total of $28,445 in principal payment goes to Tranche A and nothing to Tranche B. The ending balance is simply the beginning balance minus the principal repayment for the month. The ending balance is therefore $6.97 million for Tranche A and $3 million for Tranche B. Interest payments continue to be paid on the beginning principal balance for the month. Now, let's fast forward to the 63rd month. In this month, the prepayments amount to $40,404. Scheduled principal repayment for the month is $82,199, and the interest received, given that the beginning principal balance in Tranche A for the month is just $3,594 and $3 million in Tranche B, since Tranche A is yet to be retired, the priority is still to repay the principal balance for Tranche A. However, the principal balance is just $3,594, so this amount is repaid and Tranche A is retired after this month. The remaining principal repayments now go to the next tranche, which is Tranche B. This works out to $119,009. The ending principal balance is therefore $2.88 million, and the interest received. From the next month on, all principal should go to Tranche B. It should be noted that prepayment risks still exist with this structure, but they have been redistributed to some extent between the two tranches. Tranche A is termed the short tranche as it matures first. It offers investors relatively more protection against extension risk, but higher exposure to contraction risk. Tranche B, termed the long tranche, provides relatively more protection against contraction risk, but higher exposure to extension risk. What if Mario prefers to have protection against both extension and contraction risk at the same time? In such a case, a planned amortization class CMO may be more appropriate for Mario. Under such a structure, The distinction is between PAC tranches and support tranches. Reducing the prepayment risk of the PAC tranches is achieved by increasing the prepayment risk of the CMO's support tranches. This is how the payments are structured to achieve this objective. Recall that the PSA is a measure of the prepayment rate against the benchmark. The higher the PSA, the higher the prepayment rate. Let's say, for example, that initially the PSA of this CMO is expected to be 250. Based on this expectation, the underwriters can prescribe a scheduled monthly prepayment amount that will flow to both the PAC and support tranche and give an estimated average life for each tranche. If the prepayment rates remain as expected according to PSA 250, the estimated average life will be achieved. However, as we've learned, changes in market interest rate can increase or decrease the PSA. If the repayments are more rapid than expected, the support tranche receives the repayments in excess of those expected for the PAC tranche. As such, the prepayments for the PAC tranche remain at the scheduled level. Its estimated average life should not change, but the support tranche will see its estimated life reduced. Conversely, if the actual repayments are slower than expected, the repayments to the support tranche are curtailed so the scheduled PAC payments can be made. Again, the estimated average life for the PAC tranche should not change, but the support tranche will see its estimated life increased. However, there are limits to how much the support tranche can absorb before the impact of the deviation is spilled over to the PAC tranche. For example, this particular support tranche may be able to handle faster prepayments up to a limit of PSA 350. Prepayment rates faster than that may cause the estimated life to drop. Likewise, slower prepayments of up to a limit of 150 can be fully absorbed by the support tranche. Prepayment rates slower than that may cause the estimated life of the PAC tranche to rise. This limit of 150 to 350 PSA is known as the initial collar. If the prepayment rate is outside of these bounds, such that payments to a PAC tranche are either sooner or later than promised, the PAC tranche is referred to as a broken PAC. The size of the support tranche in reference to the size of the PAC tranche will affect the width of the initial collar. The larger the support tranche, the smaller the probability that the cash flows to the PAC tranches will differ from their scheduled payments. Let's conclude this lesson with a quick discussion on non-agency RMBS. In the US, such non-agency securities are issued by entities other than Ginnie Mae, Fannie Mae, or Freddie Mac. They're not guaranteed by the government, so credit risk is an important consideration. The credit quality of a non-agency MBS depends on the credit quality of the borrowers as well as the characteristics of the loans, such as their LTV ratios. To be investment grade, most non-agency RMBS include some sort of credit enhancement. Credit enhancements play an important role in obtaining favorable credit ratings, which make non-agency RMBS more marketable to investors. The level of credit enhancement is usually determined relative to a specific credit rating desired by the issuer for a security. One very common credit enhancement technique for non-agency securities is credit tranching. As we've learned earlier, credit tranching redistributes credit risk such that the subordinated tranches bear most of the credit risk. Credit tranching for non-agency RMBS works on the principle of shifting interest mechanism. If prepayments or credit losses decrease the credit enhancement of the senior securities, the shifting interest mechanism suspends payments to the subordinated securities for a period of time until the credit quality of the senior securities is restored. Many non-agency RMBS also include other credit enhancements, such as over-collateralization and reserve accounts. Do refer back to the lesson on legal, regulatory, and tax considerations on how these credit enhancements work. And that concludes this lesson on residential mortgage-backed securities. In our next lesson, we shall turn our focus to securities backed by a pool of commercial mortgages. See you again.